everyone. Happy 4th and welcome or welcome back to The Lens with Larry Shapiro, and our host is coming back today, Larry
Oh,
McDonald.
hold on.
So,
Hold on. Larry Shapiro. Let's start with.
sorry, Larry McDonald, Craig Shapiro. So, remember, guys, we're here for you every week. We missed last week because some troubles inside, but don't worry, we're fully back right now. Remember, we have an institutional chat on Bloomberg. We have a Discord live chat. We have our daily client chat recap, turning point on our one idea. We also came out with a new product called Washington Pressure Points. The guys are going to go a little bit in depth throughout the video. And remember, if you're interested in any of the reports or information mentioned all throughout this video, you can email info@thebirdshopsreport.com. Thank you, and go ahead.
Thank you, Valentina and Craig. Happy 4th, everyone. Any big plans for the weekend, Craig?
No, just rainy Florida for me. Was traveling last couple of weeks, and so back at it this week. The weather is kind of crappy down here. It's the summer of afternoon showers in Florida has begun. So, we'll figure something out though.
Well, we're heading on the West Coast, so I'm excited. We're speaking in Vegas at the Money Show conference, and then what we try to do at the Bear Traps Report is all year throughout the years we do ideas dinners. Now we're going to head to LA, Los Angeles, and San Francisco on the heels of the Vegas trip that's in July, and we'll have details coming out. There's some on the screen there. So that's going to be really great because what we do is in the chat behind us we have institutional investors in more than 20 countries, and we're kind of crowdsourcing information, sharing that information, kind of our intelligence gathering with family offices around the world. And what I really like is the ideas dinners where we're really working with the PMs on the East Coast, West Coast, Florida, wherever we're going to be. Craig, the one couple things this week from the chat, and you're running the Discord room, so anybody that's coming off a plane, a long meeting, join Craig in the Discord room. It's a revolutionary platform, really, because we're bringing buy side investors together with family offices, wealth managers. But I think the bigger trends this week in terms of new trades, Craig, the lithium names, ALB, there's a political backdrop in Chile which is very bullish. It reminds me a lot of say the copper trade 6 or 9 months ago, where you're coming into some real good, much better situation politically, and then the setup for supply and demand. So that's something I thought is interesting this week. And the other was the coal names. The coal names have really are bombed out village, but you're really starting to see core natural resources. Great buy down here. We've been recommending some of the coal names in recent weeks. Craig, what stands out for you?
Yeah. No, look, this has been a bit of a transition week, right? You had the end of the quarter, you had the beginning of the quarter. So you get some of the flows that come in at the beginning of any quarter. Plus, it's a shortened week because of the holiday, but a ton of macro data, including the payrolls data that came this morning, which was better than expected. People had feared the worst, so you better than expected. So, 4th of July, new highs at the 4th of July. So we're here. But I think the market, to your point, is starting to pick up some of this rotation, right? We saw some unwinds of crowded momentum trades to start the quarter, and some of these laggards in commodities and some oversold names and some of the most short names have really started to pick up momentum here to end the quarter, and then for the first 3 days of the third quarter. So as we head into next week, the question will be: is this rotation going to continue, or are we going to go back to just buy NVIDIA, buy the AI names, and go? And so, I think, setting up for earnings season to kick off next week, it'll be interesting to see if this momentum unwind continues, or if we, just go back to the old themes.
Well, one thing, Craig, one theme that we've seen over the years is that when you have a piece of legislation that is meaningful, that has, and this one has some growth elements to it, but that's a little bit more of a debate. Everyone says, the consensus is that the 2016 to 20 regime with Trump, with the tax reform, had much more stimulus in it. But when you have stimulus that's really focused at home, That should help the Russell versus the Qs in the second half. So that's one thing I think that's a trend and that gets back to your point around quarter end, month end, new quarter into the second half of the year, rebalancing. That's another theme that I'm hearing but the question is how much growth stimulus is there in this bill?
Yeah, and the other thing about this bill and this administration, right, is you counterbalance it with tariffs, and to what extent are the tariff announcements and the tariff deals that we get, are they going to be a headwind to growth? And so while they'll help the deficit situation because the government will be taking in more revenues, that provides a bit bigger of a headwind to growth. And we saw yesterday with this deal with Vietnam, a 20% tariff on all goods from Vietnam and a 40% tariff on transshipment goods. I think those numbers were higher than what people were thinking, right? We took the pivot, the taco pivot back down to 10% reciprocal tariffs. And then it was supposed to be the case that the earlier you signed a deal, the better off your deal was going to be. So if the best deal came with Vietnam at 20%, I think there's upside risk to what consensus is thinking for tariffs, to the next week when we get these deadlines. So the question on this rotation into small caps and growth and this fiscal that you're talking about is how stimulative or how contractionary will it be? And so, there are definitely some targeted stimulus concepts in this bill, but there's also some headwinds, right? And we're also seeing some, the cutbacks in some of the Medicare and SNAP and other types of spending habits for lower and middle income people. As the labor market continues to slow and you have some of those supported programs being taken away, there'll be some headwind on the momentum on that front too. So, it's a fascinating time. This bill is still, Hakeem Jeffries is still talking, I think, at this point.
Is he still going?
But the bill, after the rule was agreed to overnight, it seems like this bill is going to get done. And then the question then shifts to Treasury issuance, right? As we've talked about, I know the new Washington report really gets into is that under the debt ceiling restrictions, Treasury has not been able to issue any new net debt over the course of the last 4 or 5 months. And so once this gets lifted as early as tonight or tomorrow, starting next week, Treasury is going to be able to ramp up issuance again. It's going to be focused in bills at the beginning. And at the end of July, we'll get a reading from the Treasury whether or not coupons are going to be part of this restock. And with some of the comments that we've gotten from Trump and from Bessent over the course of the last few days, it's unclear whether this administration really is going to be adding to coupon issuance. They think the rates are too high. Trump has said he's instructed Treasury not to issue any long-term debt. Bessent seems to be on board with that notion. And so it'll be fascinating to see, what they ultimately decide at the end of July for the next quarterly refunding announcement. Go ahead, Roy. Yeah.
Well, Craig, one trade I'm hearing from investors, and what I try to do is look at the shifts in the narrative. And so the dollar, and we've been dollar bears in our book, How to Listen to Markets Speak, is a big focus on the dollar. And I just think, the dollar had its worst first half since I think the 70s. And one thing I'm hearing, Craig, and I want to run this by you, like you said, when you don't issue any new debt for that period of time, and we saw this with Yellen 2023, 24, and then you have to ramp it back up. And like you said, if you're ramping it back up on the front end, and all that means is T-bills, 1-year notes, 2-year notes, not the longer stuff. If they really want to do that, that's going to basically support the dollar, because spreads between the United States and Germany and the rest of the world on the front end are going to go higher. In other words, our yields on the front end, that means 6-month treasuries, 3-month treasuries, 1-year treasuries, T-bills. That's going to suck money back into the dollar. And so what we've been doing is taking profits in some of our high beta names, uranium. We did a number of trade alerts, and anybody that wants to get into our trade alerts, clients, info at thebeartrapsupport.com. But in April, we had our highest and most busiest 12 to 15 day period in the copper names and the uranium names, the power names, the NUKZ. And now we're taking some of that stuff off, half of it, because of this potential move back up in the dollar. Craig, are you hearing, like, I'm seeing guys like that were really bearish on the dollar kind of taking some of that off now, because this snapback in issuance. And what is it, Craig? What's the total number? 1.7 trillion, 600 billion more than last year between, say, August 15th and the end of the year.
Yeah, look, I mean, if it's actually going to start sooner now. I think the original thought would be that the bill was going to take until August. So now that all this issuance can really start as soon as next week, once the debt ceiling is lifted, which it will be immediately. And so, yeah, to your point, look, I think sentiment on the dollar is very, very washed out. Most of the readings that I'm seeing show, very oversold levels. I think structurally, the weak dollar idea is going to be with us for a while as overseas investors hedge their currency exposure in a much larger degree than they did prior to Trump. But I think we're poised here for a bit of maybe a snapback rally or some relief where the dollar kind of can digest some of this oversold move, and the heavy issuance of bills in the short term here, I think, is going to accelerate that. Now, the question will be, how much does the Treasury decide to restock the Treasury general account? Yellen had operated with 800 billion plus in that account. It's down to 350 now. It's not clear that Bessent's going to take it back up to 800, but the more that he does look to restock the TGA back to those levels, that's going to suck liquidity out of bank reserves. It's going to draw liquidity.
And explain that, Craig, to fill that back up. So he has to put 500 billion to it. That's he has to issue bonds.
Right. You have to find you have to find the money from somewhere. Right. And so what we had back when Yellen did this in 2023, when the debt ceiling was lifted, is that the reverse repo facility had $2.5 trillion in it. And so she was able to mop up the extra issuance by taking the capital out of the reverse repo facility, and that funded T-bills. This time around, the reverse repo facility has largely been drained. We're back down, I think, back under 300 billion, and we've been operating in the 100 to 200 billion dollar range for most of this year. So there's less ability for the reverse repo facility to suck up that incremental issuance. So it's going to have to come from other places, bank reserves or foreigners. And we know that foreigners have been less desirous of putting capital in the U.S. to start the year. And so more of this is going to come out of bank reserves, and the banks are going to have to step up and take down more of this issuance. So on the margin, that's liquidity tightening here than what we've seen. And so, hundreds of billions of dollars of issuance coming over the course of the next 3 months is likely going to have some impact on the rest of the risk asset universe. That's why there's also been tremendous pressure from Trump and now increasingly from Bessent on the Fed to lower rates, right? Because if the Fed then ultimately will bring rates down, that would help prevent this dollar from rallying. That would help cut interest expense. And so there's a bit of reflexiveness and circularity here. But, the bottom line is Treasury is going to start issuing a lot of paper, likely starting next week. And we'll see how much the market is able to digest that.
Right. And in tracking the birth of a narrative, the Dalio, Paul Tudor Jones, Gundlach bear case for bonds was so well known. I mean, it's been out there about a year, and it kind of climaxed maybe 6-7 weeks ago. And what we noticed in the chat and in the Discord room, and we tracked the kind of the birth of these narratives, and when we see a rates client or a FX client that we really respect, that we've known for 10 years, and 2 to 3 or 4 people start to shift the narrative toward Bessent's bag of tricks. That started about 4 or 5 weeks ago, Craig. I know you were pointing that out. And all that means is the SLR, the supplemental leverage ratio, all these things that have been coming out have been supporting bonds, right? So it's almost like you've got that kind of bond bear case that was extremely well known. And then we know that Druckenmiller is probably talking to Bessent every day. So you've got 2 of the smartest macro minds in the history of humanity that are kind of running things from the Treasury. So they're smart guys. They put forth this plan. That's why bonds are rallying. Now we come into this period where the Liz Truss probability kind of rises, because that's when you're issuing all that paper, they need to get that SLR buying from the banks in. Question is, there's not a lot of clarity on timing, even though the Fed and Bowman, who's a Trump appointee, the regulator there, they've made some big moves, and they're going to try. I think they're going to try to force the banks to buy treasuries. But the question is, it's maybe 250 billion of buying, but when is that buying? It's not the next 6 months. That buying from the SLR probably comes up in the next year and a half, right?
The other dynamic in play here too is Bessent and Steve Myron were very critical of the previous administration and Yellen's strategy of issuing bills over bonds, right? I mean, they were pounding the table on this. Myron wrote a big report about this at the end of the year, and Bessent was very critical of it as well. And I think there was an expectation because of those comments that when this new Treasury team came in, that they would seek to lengthen the duration, lengthen the weighted average maturity of Treasury issuance. It seems like now they've kind of thrown that plan out the window, right? I mean, it looks like they are going to do exactly the same as what Yellen did, maybe even more aggressive. They may even look to cut issuance of duration securities
which shows you that they think they're going to really have a new Fed chair that's going to cut aggressively. But the problem is that's not till there's a little bit of time lag.
There's a window here, yeah.
But so if you're them, they're like they threw in the towel around longer dated issuance because they know they're going to have maybe 100 bips of cuts between now and say, I don't know, May next year. But that's a risky game to live on the front end of the yield curve like an emerging market country.
Right. No, and you'd think, over a period of time, to the extent that the government is funding itself with short-term paper and kind of aggressively trying to force the central bank to cut rates, that would be negative for the long end over time. It'd be negative for the dollar for sure over time too. So look, I think Treasury and the administration is trying to balance, a lot of these things. I think they came into the year with an aggressive plan regarding tariffs, regarding issuance, regarding this detox period, shifting the economy from public to private. And then as the risk market started to sell off at the end of March and throughout April, Trump kind of came in there and was like, yeah, you know what, guys, I'm not really sure I like this idea. I'm not really sure I really like markets falling. I know you talk about detox, but you know what? I think we're better off just running it hot and seeing what happens. And if we're right about productivity gains and we're right about energy costs coming down and we're right about deregulation, and Trump just gets very loud and aggressive on any companies that seek to raise prices, we don't really have an inflation problem. So I think they've transitioned a fair bit. And so, this run it hot strategy with the economy, with the issuance, and hope that they're able to pressure the Fed. They're able to just do bills over bonds. They're able to keep attracting capital because the AI boom is still here. And so big cap NASDAQ companies are still able to attract capital. And to me, that seems like the plan that they are aggressively promoting. And that's, I think, why NASDAQ's making highs into the 4th of July, and bonds have not really sold off commensurate with this one big, beautiful bill, deficit enhancing bill that we've gotten. And, we'll see. But the economy does appear to be slowing from here. And so, and the administration, I think, is a bit concerned about housing. I think they're concerned about the low-end consumer. I think they're concerned about labor market momentum. And so they'd rather the Fed kind of get at it and start cutting now to help support the economy sooner rather than later. But, after the payroll numbers today, and given the Fed's propensity to believe that tariff inflation is coming, July seems off the table. September is likely the earliest we're going to get something. It may be a little bit late to save this momentum.
Yeah, and the moving down the dollar has created a big move in what we call the Bloomberg Commodity Index. And the divergence between the Bloomberg Commodity Index and CPI is so Bloomberg Commodity Index is trading up like this, and CPI has been trending down. Typically, that can't go on too much longer, So the weakness in the dollar the last several months is feeding into commodities. All of a sudden, we have another decent jobs number that's going to feed into inflation expectations, and then we're just going to be back at the inflation trough again. But Craig, we want to keep it short, holiday short and week. Everyone have a great weekend. Those are kind of the big trends. Join us in the Discord room with Craig. info@thebeartrapsupport.com. Get on our trade alerts, and let's have a great 4th with the family.
Sounds good, Larry. Take care.
Okay, thanks.
Bye.
Thanks, Larry. Thanks, Greg. And thanks, everybody, for joining us this week. As Larry mentioned, our book, When Markets Speak, has been in the top 10 for the last maybe 6 months. So we're really excited. If you don't have yours already, remember to get it on the description below. Also, we'll be in the West Coast mid-July. Larry will be at the Money Show on July 5th, on July 16th. Then we'll be in San Fran from the 17th on, and we'll have our Diaz dinner and cocktail party in LA on July 22nd. So we're looking forward to having you there. Thank you so much for joining us, and enjoy your 4th. Bye.